Hi, my name is Kristen Torres, and I'm licensed in the financial industry. I'm out of Nashville, Tennessee, although I do have clients in over 37 states. I run a financial firm with about 30 licensed professionals across the United States. My previous career was nursing, so I used to be a registered nurse. I worked in healthcare for over 15 years. Although I love helping people, I did see a greater need in helping people in the finance industry because unfortunately, we're not taught a lot of the basics when it comes to money. So in 2018, I got licensed in the state of Tennessee. And from then on, I went full time into the industry in 2020, started my own firm, and here we are today. We're very, very big on education. So if you asked or requested for this video, this is basically for you to learn some of the basics about money. And if you have any further questions, to reach out for additional information or a customized financial plan. Here at our firm, we are what you call non-captive, which means that we're able to access or have access to over 70 A-rated companies. Well, why is that important to you? Because everyone's situation is different. So when you're able to customize a person's financial plan based on their needs, it does help them reach their goals a lot more efficiently. So on the left, you see some of the things that we are able to do at our firm, from long-term care plans to legacy plans to IRA 401k rollovers, executive bonus plans for business owners, wills and living trusts, and so much more. So what we're doing is we're looking at your portfolio from a more complete and total perspective, and some of those holes that are missing and what you need to get you where you want to go, we're able to fill in those holes. Now, what we do is after we figure out what you need, we go to the company that's going to provide that product or service the best. Pacific Life, Nationwide, Prudential, Transamerica. Those are some of the companies that we work with, but it's over 70 A-rated companies. So I'm sure some of these companies do look familiar to you. But again, we find what you need, and then we find the company that would provide that service or product the best for you and your situation. So like I said, we're really huge on education. And so that is the basis of you watching this video. I do want to go over the 3 rules of money. The first being the rule of 72, which we call the rule to compound interest. So if you want to know how long it takes for money to double in any given situation, you take the number 72 and you divide it by the interest rate that you're being given. A lot of times people put their money in banks, which gives them less than 1%. But let's just say you have a bank account that has 1% or is giving you 1%. Well, if you had $10,000, you would take the number 72 and you would divide it by the interest rate, 1%, which would equal 72 years. So it would take your money 72 years to double in that situation, right? So $10,000 would take 72 years to double into 20,000. A lot of people don't have that kind of time, but they definitely are shocked to learn that it takes money that long to double at 1%. So let's say that you're on the other end of the spectrum here and you're earning, let's say 12%. Well, 72 divided by 12 equals 6. So now your money's doubling every 6 years versus every 72. And that's definitely something that you can retire off of or pass down to the next generation, right? Because it's actually doubling in your lifetime. So definitely keep this equation in your head, 72 divided by the interest rate, to know if your money is in a profitable situation. The next rule of money is what we call how money grows, or we call the protection phase. So the first one is the accumulation phase, which is the rule of 72. Protection phase is talking about how money grows. So there's 3 ways that money grows. The first is fixed. That's like when you put it in a bank or a credit union, and it grows like this flat line you see here. So fortunately, it is in a safe environment, but unfortunately, it is at risk for depreciation. Why do I say that? Because inflation is usually higher than the interest rate that people are earning in fixed accounts. So you definitely want to be careful and make sure that all of your money is not sitting in a place where it's depreciating. Second is variable. That's anything tied to the market, right? Your 401ks, your IRAs and stocks and mutual funds and, anything tied to the market. So we know that when the market's going up, you're making money, market's going down, honestly, you're losing money. But here is the thing that a lot of people don't get to learn. And so I remember learning this about how the market really works. And ever since then, when I'm talking to my clients, this is something that I draw out for them so that they can get a visual. So let's say that the market is going up and down. And at this peak, you have $1,000. If the market goes down 50%, what are you left with? 500. Now, if the market goes back up 50%, a lot of people would say, hey, if I never added to or, took away from this $1,000, I just left it as is and it went down 50%, but then went back up 50%, I would be back at 1,000, right? Well, that's what we think. But honestly, if you never added to or took away from this $1,000, when the market went back up 50%, you would only get 50% of what was left after you lost. So that equals $250 in gains. And so now you're at 750, not 1,000. Also, please note, you did lose money, but you also lost time. Something that honestly, we can never get back. So truly that is what's happening in that situation. Now, there is a third way that money grows, and it's something called indexing. Indexing is where you can get the gains of the market. So the part that everyone loves about variable accounts, they love, the increase in, probability of rate of return that they're going to get with that. But then there's also the loss. Well, indexing allows you to capture the gains without the loss. So yes, there is a way for you to grow money without losing it. So you see here where the line goes up and then it plateaus. There's a lock above it. Well, that's signifying that, hey, the market went down, but you get to keep your gains and what you started out with, your principal. Then when the market goes back up again, you gain again. So you're always gaining, never losing in indexing. So of course, if we were to compare the two in that same drawing, same $1,000, but now when the market goes down 50%, it's almost like you drew yourself a bridge. So you saw that plateau on that picture and that lock. That's what you essentially did. So when the market goes down 50%, you don't. But when it goes up 50%, you do. So that would be 1,500. And as far as time, you did not lose any because you didn't lose any money. So that is how indexing works in comparison to variable. Now, the third rule of money is regarding taxes. And this is a very important subject, again, that we like for our clients to understand. And so this is the distribution phase. And so first we have tax now accounts. Those are like your CDs, mutual funds, savings accounts, brokerage accounts. And so we know, when you have a job, you're taxing your check, or if you have a business, you pay quarterly taxes or annual. When the money grows in these accounts, you're also taxed on growth. And for a lot of these accounts, you're also taxed on some type of distribution. You've got brokerage fees, capital gains taxes. So basically the point is you're always having to give up some of what you earned in tax now accounts. Now, tax later accounts, those are the types of accounts where you get to defer your taxes. So when you have a job and you have a traditional 401k, or if you have a traditional IRA, right? Pension plans. With these, you go ahead and put money into these vehicles and you do not pay the taxes on that money. And you don't even pay taxes on the growth, but you do pay taxes on the distribution, the back end. So 2 questions I love to ask my clients. 1, what kind of tax breaks or write-offs do we get in retirement? And they always say, I don't know, or none. And the answer is none. Yes, that's the reason why a lot of people don't know. So there's nothing to look forward to in retirement as far as a tax break. But while we're younger and we're in our working years, we get tax breaks on all kinds of things. So why not save that tax break, that special tax break for the time in your life when you don't have any? And that's on your retirement accounts. So the second question I always ask people or my clients are, do you think taxes are going to go up or down in the future? And the answer used to be a mixed answer. Some people would say yes or no. That's about 2 or 3 years ago, but now everyone says yes. And so I always love to refer to this website right here, what we call usdebtclock.org. Now, this is a website that you can visit, usdebtclock.org, and pull it up on your computer or your phone. But this is our nation's debt in real time. As you can see, we have run it up quite a bit, especially since last year. Last year, we crossed over 30 trillion, and now we're at 31.5 trillion around the same time. And so why is that important for you to know or understand? Well, the thing is, although the debt is past 31 trillion, if you look at this number right here, debt per taxpayer, that's basically saying if we took all the tax-paying citizens in America and we divided the debt up amongst all of them, That would be $246,867 per tax-paying citizen if we were to pay our nation's debt off. That's what that means. So that's a lot, right? And a lot of tax-paying citizens are saying, wait, hold on. That's basically saying, if I were to pay my portion of the nation's debt, that's almost $250,000. Yes. And as you can see, this number is continuously going up. It's not going down. So if you have debt and you want to at least slow it down or maybe even pay a little bit of it off, you have two options. You either cut spending, right, so that you can rearrange your budget and put it on your debt, or you increase revenue to put onto the debt. Well, guess what the government's going to reach for? They're going to reach for increasing revenue, which means increasing taxes. And taxes are projected to go up significantly higher than what they are now. Also, if you look on the screen, you see other budgets, Medicare and Medicaid, Social Security, those are going up. Why? Because of baby boomers. And so there's a lot of stress on Social Security, and the trust fund is supposed to be depleted by 2034, if not sooner. So the situation that our country is in regarding taxes is very, very serious. And so if you know now that taxes are going up in the future, how do you avoid paying higher taxes in the future? Well, you pay as much as you can right now. So those are with tax advantage tools. So with tax advantage accounts, you have Roth IRAs, municipal bonds, executive bonus plans for business owners, LERPs, life insurance retirement plans, also called cash accumulation and insurance policies. This is a way where you can pay your taxes now, and when the money grows, you don't pay taxes. And then when taxes are higher in the future, you don't pay taxes on that distribution. So a lot of clients say, oh my gosh, well, I've learned a lot. I didn't know that, there were ways to grow your money where you didn't lose any. And I also didn't realize that if I'm not paying my taxes now, I'm probably going to be paying higher taxes in the future. So to round this all up, we look at the client's financial portfolio, right? There's 6 main areas that we're looking at. The first is cash flow. And sometimes that's a true cash flow issue, but most of the time is what we see is a budgeting issue, meaning people make enough money, but they're not budgeting. And so they're not saving for the future. Number 2, college planning. There are other college plans out there that are not restrictive and that are not tied to the market. So we're always educating our clients, our parents, and our grandparents on what those types of accounts and funds are. Number 3, emergency fund. Having 3 to 6 months of unexpected expenses, just in case, what happened in 2020 doesn't happen again. Proper protection, that's basically talking about your life insurance. And so making sure that you're properly protected, which most people are not. They'll say, hey, Kristen, I have a $50,000 whole life policy for burial. But what about, all the debt you leave behind or the income that people are dependent upon? You want to leave at least 10 years of that, paying off your mortgage, leaving educational funds for your children. So you want to add all that up, and that becomes your insurable need. And if that does not equal how much life insurance you have, then you definitely need to make sure that you fill in those gaps. Number 5, building wealth, putting the money where it's actually going to grow and outpace inflation. Inflation is super high right now. So if your money's not growing at least the rate of inflation, you're relatively losing money. And number 6, preserving that wealth, keeping it from estate taxes and lawsuits and probate, anything that would take away from what you're trying to leave behind. You should be legally protecting that. And so we do work with a team of lawyers that help our clients with wills and trust and things of that sort. So if after watching this video, you find a need in any of these 6 areas and you say, you know what, I definitely need someone to look at my financial portfolio. It's been a long time since I have looked at, these areas, or I've never looked at these areas before, definitely reach back out and we'll go ahead and set up a time to do your financial needs analysis. All of our services are complimentary, so you do not have to worry about being charged for our services. Thank you, and I look forward to helping you in the near future.